Welcome to today's roundtable. We are our conversation with Alberto, where we're going to talk everything secondaries and the sales side of it. Maybe if I could ask you, Alberto, to just give everyone a quick introduction to yourself and Giano Capital. What's your experience with secondaries?
Thank you very much, Andreas. Thank you, everyone, for being here. It's a great pleasure for me to be here today. My name is Alberto Chalon. I'm a founding partner of Gianno Capital. Gianno Capital is a new fund. We had our first closing last year, and our mission is mostly to focus on secondaries, single asset, which we're gonna then explain what is the difference with the usual secondaries. In a nutshell, we are looking for digital tech company within the European space that are doing at least 30, better 100 million plus revenues, that are growing at least 30%, that are profitable, that are cash generating, and they have a plan for an exit in the next 2-4 years. And then I will explain why we can enter into this company through secondary transaction. Our fund already deployed some capital. Officially, we have 2 transactions. One is with Get Your Guide, the second one with Fin, and there is a third one that we announce in the next 7 days, which is still, I cannot confirm, but we are very close to a very, very interesting closing in one of the most well-known brand in Europe.
Amazing. And today, today, I was about to say today, but these days are definitely the days of secondaries. A lot of opportunities are out there right now. But today we're going not to be talking about the buy side, which you're on, but the sell side rather, because obviously our core audience on the European VC podcast are all VCs. And for that reason, it's oftentimes more on the sell side that they're trying to figure out exactly how do the mechanics work here. So maybe before we dive into it, Alberto, if I could just ask you to give us an overview of the secondaries market, and then to the rest of you, you will hear everything about the key players and the stakeholders. What are the types of sellers in this market? How do you interact with intermediaries? What's the buyer process like? How to prepare the sale from a fund? How do you work through valuation and pricing, and all these topics that I know are really pertinent to you. But first, I just want to start with this overview. So maybe Alberto, give us a take on what are you seeing being the core definitions and key components related to selling in the world of direct secondaries and fund secondaries?
Yes, sure, with pleasure. So first of all, we need to understand that the market in the last 20 years has changed very much. So if you remember, for the one that was already in this market, in the year 2000, companies with a simple idea or just the starting of revenues, they go immediately listed, right? And we had this crazy bubble that, of course, has been a big mistake. But in a nutshell, you could have an exit very quickly. Nowadays, if you consider that the average exit it's 12, 15, 16 years, you understand that there is a great opportunities for secondaries. This is one. And why this exit it's longer? Of course, in the last 2 years, we all know the IPO market, it's shut down. That's true. But it's longer even when IPO, its market is open. Why? Because there is a belief that I think it's true and it's right that bigger is better. So now companies usually try to get an exit when they reach at least 100 million plus revenues. And to get to this point, it takes 10, 12, 15 years. And if you're also looking at the other side of the market, potential buyer, which is PE buyout, again, bigger, better. And also strategic, often they look at certain size, except some exceptions. So in this long journey, you have at some point, starting year 7, 8, 9, and 10, you have an opportunities to jump into this company through secondary transaction. And there is a real need in the market, and especially in the European market, because then I want to focus a little bit more in the European, because we live here. And I think our market in respect to the US market, we are, as always, behind like 5 to 7 years.
Yeah, no doubt about that. And also probably what prompts secondaries, oftentimes we're also moving a bit later, because at least that's what I observed when we saw this huge boom in secondaries. Definitely something that we saw moving in the US early as well. Do you think that as or where would you say, just in this US, your comparison, because we hear all so much from the US, what do you think that anyone listening to all the prodigies in the US talking about venture capital, what do you think that you should keep in mind as a European investor when you're hearing US investors talk about secondaries?
Okay, first of all, I think we need to make clear that we have two main big difference between Europe and US. A, it's the mindset of the investors. Most of the US investors are much, much more risk taker than the average of the European. This by definition, and historically, this is what we are seeing. Two, the regulation in US is made in the article of any of the private company. And I would say, with all the respect, strategies, you join this second round. This is not possible in Europe because everything stays private. So to do your proper job in Europe, you need to be capable to access to the founders, to the managers, to the cap table, to the official information, and you need to have a dialogue. So this is the big difference between Europe and US.
Yeah, absolutely. Okay, but then now let's dive into sort of the meat of this, meaning defining the key players and stakeholders. If we start with the types of sellers that we have in the market, could you just describe them and specifically focus on the motivations that you should pay attention to?
Yeah. So we have two big groups of potential seller. When you approach a company that is, I would say, 10 years plus old. A, there is the founding team, employees, and former employees that has been working since inception, or maybe in the last 7 years, has been accumulated on paper some value, and it's totally acceptable. And I think this is a further motivation to push, and it's a full alignment of interest if this person wants to monetize up to, I would say, 20% of this participation. That's totally. With this capital, founders and actual employees will increase a little bit their life. They might buy an apartment. They might be capable to send their next generation to top university worldwide. And this capital will make them more motivated to work very well until the end. This is the first group. The second group is the early stage investors from business angel, seed, and round A. So these people, for several reasons, needs to find liquidity. So the venture capital, the GPs, as you know, they are lacking about DPI now, and they cannot wait 15 or 16 years. Even they can wait for a greater return. At some point, we have, especially nowadays in Europe, we have a systematic problem. If we want to keep our venture capital credible, we need to return capital, because otherwise we will not be able to raise more capital. And here, the only way we have today is to try to have partial liquidity event to return this capital, increase our DPI, and then having new capital, new energies for then invest in early stage companies. And then when it comes to the business angel, when the company reached this size, has no more relationship as he had in the early days with the founders. And his role, it's end. So it's happy to have his 20, 30, 50 time return money, getting the cash, and finding new amazing founder and start again this journey. This is his mission. So those are, in a nutshell, the seller we can find in the market. And this is the one that are populating the secondary market.
How about LPs? Because that's also a group that we often see. What's your take there? How important are they? When do they choose to liquidate themselves? Is it even an option? Could you talk a bit about that?
Okay, so I don't know if by LP you mean LPs in a fund, I imagine, but when this is the case, it's not for us, because this is more for people that are doing secondaries in funds. So they buy LP stake or GP stake. Because we're going in a single asset, we look at the cap table level. And the cap table, for me, my counterpart is the GP. and the fund itself, and it's not the single LPs. When you do secondaries by funds, of course, the LP stake makes sense, but not for us.
Yeah, exactly. And we're going to talk much more about that at a later point in a later one that we're going to do with our good friends at Isomer Capital, because that's what they're very specialized in. They're doing 70% of their secondaries fund into these types of investments. But today we're focusing entirely on the direct. So then let me ask you, what about the role of intermediaries for sellers? How do brokers and intermediaries assist or not assist, which is maybe the more important part, in this selling process?
Okay. What we have seen again in US, there is a lot of broker that usually and typically doesn't assist much. What usually they have either the supply or either the demand side, and then they're trying to find the missing part of the market. In Europe, it's often the case where you have either banks like Goldman's, Morgan Stanley, Deutsche Bank, or you have M&A boutique that can take care about the secondary transaction exactly as they are taking care about the primary, where there is a clear process, where they give you access to full VDR, where they are available for Q&A, they are like connecting point between you and the manager and support this transaction. But this happens only when the secondary is an official process. I would say there is a decent size, I would say 30, 50 million plus, and this is the case. And if it is less, I think it's more to one-to-one transaction. Gianno can interact with the management and, try to get all the information needed and to arrive to a go-no-go.
Could you tell me a bit, Alberto, about how to best, as a seller, engage with these intermediaries?
First of all, the seller, we have to make a distinction. First of all, if the seller is a GP, I always recommend, first of all, to align these opportunities or these requests and the needs with the founder and with the top level managers. Because as we are going to discuss in more details, without the consent about the majority and the board, this cannot happen. So then once you have these opportunities, and here it's very important how you explain, because sometimes some of the GPs, they are a little bit reluctant to go to the founder they have sustained for a year saying, look, I need liquidity, because they don't want to look like they are not believing in the company. But actually the way they have to present it is that, look, there is a bigger picture here. I need to look also about my fund, about the DPI. And I think your asset, because it's a great asset, is an asset that I can more easily liquidate for my bigger picture. It's not that they do not believe anymore in the company and in the founding team. And when this message it's understood, you might have the support of the founding team and the manager. And here, if the transaction maybe involve them, because at this stage they may say, oh, look, it's a great opportunity also for me to get some liquidities, they can together engage a bank or an M&A boutique that will help them with the process.
Yeah, makes sense. Makes a ton of sense. Okay, but then let's shift to the buyer process and understanding the process of a sophisticated buyer. And I think that here, I really love your framework because everyone has frameworks for how they invest and how they think about deals. And but not everyone is as clear about it as you are, Alberto. And I really enjoyed getting to know that the last time we spoke. So maybe let's just, understand the process of Giano Capital when you go in and connect it to that. Let me just bring up a question that we got from the audience. It was Darin. He asked, what is your minimum and max amount for your secondary purchases? Just do a bit of conversation on that as well.
Yeah, at Giano Capital, I would say that our sweet spot is in the range of 10 million, but we can get lower and higher. So 10 million is the sweet spot.
All right. Okay. So with that out of the way, now let's dive into the model of Giano Capital. So if I just line up really quick, then you can talk about the individual aspects of it here. But let me ask you. So you have this process where you're starting out. It's a 1, 2, 3, 4, 5, 6 step process. You've got the first step is the quantitative, the scorecard. Then you've got a second step, which is the more quantitative, detailed look. Then you go into a qualitative analysis, and then only then do you go into valuation and agreement on price. And after that, you then discuss or define the legals and do the financial DDs with external parties. So we're going to talk a bit about that. And then in the end, of course, you close the deal. So that's your process. That's how you can break it down in 6 steps. And maybe if we start on the first one, the quantitative, the scorecard approach, what are you looking for there specifically, Alberto?
Okay, first of all, we must consider our secondary transaction as a primary. So we must have a serious due diligence on the company. So this means that, again, when the company, when the management, when the founder agree to start this process, they need to be ready to share confidential information under NDA as much as they did with their previous funding rounds. So we start to ask them as much information they have ready since their latest capital increase. Then we ask for the latest audited account if available, or account financial. We ask for budget, and we ask for the 3-year plans. With that, we can already have enough number, quantitative approach to fill our scorecard. In a nutshell, our scorecard, it's 14 KPIs, okay? That's going from margins, profit, CAC, lifetime value, growth, CapEx, OpEx, all the kind of KPI that makes a lot of sense, and including multiple in the market, public comparables. And here we have a clear picture if we want to go forward or not. And why we do that immediately? Because we believe that it's very important to be capable in a quite short time to have a first understanding. If this company makes sense for us to go further, maybe it's too early, maybe it's not, it's too risky. So then after this first, we are capable, this first step, we are capable to go back to the management and start engaging and start to give them a first idea about what we consider evaluation. Because the tricky point in a secondary is always, okay, how much you're going to pay? So if the valuation and the price per share makes sense, they will keep going with engagement, and we can go for the second and third and fourth steps. If the price, we are too far, let's say I have, I don't know, 300 million valuation, and Andreas, the seller, expecting 600, it doesn't make sense to go forward. There is no room for negotiation. So, but if we align, you are going to be motivated to give me, I don't know, a few hours per day to complete the due diligence, and motivated to go forward because I know that when the answer okay, we can then close the deal. So this is the first step. The second step.
Could I just stop you here? Just because we all know the VC funnel, it's very, very wide in the top. What's it like for a secondary buyer? Is it as wide?
Sorry, can you repeat?
The deal flow funnel here. So in VC, we all know that you're looking at 1,000 deals, and then you maybe take 100 that you look closer at, and then it very quickly becomes a very narrow one. How broad is it for a secondary buyer?
I will share what was Gianno Capital numbers in the last 12 months, right? We had analyzed with a first look until the scorecard over 100 companies. And then we have invested in 3 companies, and we have, I think, 40, 50 that can still be alive in the next 6 to 18 months. So that means there are some companies that we believe that are still a little bit too early, or they're not ready for the secondaries, that we keep, in our kitchen, ready to be cooked in 6 to 18 months. So those are the numbers. The market is quite big. If you consider a company that are generating more than 30, 50 million in Europe, I think we have easily 500 to 700 if you include UK. So it's quite a big market with a lot of possibility for secondaries.
Yeah, amazing. Okay, but then let's get into the second stage, the more quantitative detail. What do you look for there?
So then once we have a first understanding about the process, about the valuation, here where we want to engage with the most strategic manager of the company. So we start with CFO, we start with CMO, of course, the CEO, and then we go down to the operation to really understand what are the numbers behind, what was the past, and what will be the future. So we want to understand where the company can go in 3 to 4 years. And to do that properly, we need to understand the past, and we need to understand the KPIs, the mechanics, and all the numbers. And when we do that, then we also like to go to the next step, where is to make comparison with competitors, reference call, standard things that you have seen in primary round at 10 million plus, because anyway, we are investing 10 million plus in this company. So we are taking our risk. It doesn't mean because it's secondary is risk-free. So we need to run a proper due diligence.
And that's the second step. Then what's the qualitative one? Or did you bundle the two here as you described them?
We bundle the two. When we start to do reference call, it start to be more qualitative. And the good things of the secondary sometimes is that when you know the market, you can call some of the board member and have insight without any conflict of interest, because secondaries probably will not be interested by this board member, and you may be getting insights about the companies. And one of the good insights we always like to ask, it's how much the managers are reliable with their forecast. This is an important question, because if you have someone that every year say, okay, we're going to do 100 next year, and then he missed by 20, 30%, this is quite risky, because then I need to cut 30. And because we always try to cut 30% to stay conservative, if someone has already a 30, it's going to be 30 plus 30, and maybe I don't want to invest in this company, because then if I think to IPO, what makes successful company is to being capable to give as much as possible precise forecast and being priced, properly.
Yeah, absolutely. Okay, and then now we're getting to the hard part, maybe, or the one that many think about when they think about secondaries. How the hell do you price this? How do you come to an agreement about the price?
Our belief is, first of all, to look and to work on the closest public comparables. So then we look what is available, and we compare our company, and we start thinking, okay, what could be today the public valuation of our companies? And then we apply the multiple of their competitors. And of course, sometimes you deserve a premium, sometimes you deserve a discount, because let's say that if your growth rate is double, you deserve a premium. If your margins are lower, you deserve a discount. And then we think, looking forward, what are the risks about this company? What are the risks that the multiple that today is available will not be available in 3 years? And then we try to arrive to numbers that make us comfortable to have our return, which is 3 times our capital in 4 years, which leads a 25% net IRR for our LPs, which is our target as a fund.
Yeah. So that's, how should I put this? This is a step where I think that many think that there's more negotiation. And also, I often hear when I talk to people about secondaries, many come in and ask, so what's the standard, discount that I should expect here? Something, well, it's a down market, so now I should be getting 50% discounts. And that's the neighborhood I should be looking for. Whereas, could you speak a bit to that idea, the whole notion of there being standard discounts that applies to secondary deals?
Actually, Andreas, we don't like to speak about discount, because discount, it's a negative concept by definition. What we want to say is stick to the reality. So why I started saying public comparables? Because I want to have the reality in face. And I want you as a seller to really understand what is the reality. If we consider the public market the reality, we need to start from that. And then if there is a discount or a premium, it will be depending by several factors, right? So I like to start by the reality. I don't like to start by the discount. And of course, if there is a discount between your previous round and the realities, this is like also happen in the public market, that sometimes your price per share drop 30%, and you should consider that is a discount from 6 months ago. Actually, you don't say there is a discount. You say, oh, my company value today less 30% than what was before.
Yeah, I wanted to hammer that point home because I think it's one that many tend to get wrong, and at least that's where I hear a big difference in how people that are very sophisticated secondaries buyers that do this all the time as a profession, and the people that are more touristy or just in a position where they only sell once in a while, and for that reason, or maybe haven't done any sales, and for that reason, get we end up kind of picking the wrong mindset to think about secondaries. Let's get to the second to last point then, the legals and the financial DD with externals. Tell us a bit about that stage. What should you be ready for as the selling party here?
Okay, so once we are all aligned on the quantitative, on the qualitative, and we are happy, I would say at this stage, to sign a LOI, I would say binding or non-binding, and we agree the price, we agree the number of shares, we agree the committed capital. The last step for us is to engage with legal team that will go through the legal paperwork, shareholder agreement, term sheet, and everything. And sometimes also with, auditor firms that will go into the bank account, business account, and to check that everything stick to the numbers that they share to us. And of course, when this is confirmed, we're more than happy to go into the closing.
Yeah, and here we have a question from Jose Martinez. He is asking which structure is the most attractive for buyers. And I think that even though you would have decided this at an earlier point, it's probably the stage to bring this up.
What do you mean by structure?
Yeah, so it's a good question what Jose thought about it specifically, but I think what's relevant here to think about is, one, you have different stock, your different places in the preference stack. So talk a bit about how you think about that, and also talk about other terms that might be in the funding rounds that have been before that you're like, then I'm not getting it. Would you ever buy common stock as an example?
Yeah. Okay. Very good question. So we buy common and we buy preferred. We also able to buy a mix between common and preferred. What makes sense is to understand how many commons, how many preferred, and which kind of preferred. And then when we do our price, of course, we need to consider what could be the chances to have a problem where the liquidation preference makes sense, and this come to the conclusion if it makes sense or not, and what could be the price per share. Of course, if we buy higher share class with higher protection, of course, the price could be higher. If we buy lower class, we deserve a lower price. What we have seen that can sometimes happen is in between a primary, the company organizes secondaries, and sometimes they're ready to change the share class to the latest share class if the whole board and the shareholder are in agreement to do that in order to give to the secondary buyer like us the maximum protection in exchange of the higher possible price.
Yeah, absolutely. Okay, so now let's go to the closing part. So the final stage of the process, could you talk a bit about how this happens? Also, maybe a bit about timings. How quick does this have to happen? That type of thing.
Yeah. So first of all, when we have, I would say, the green light from lawyers and from auditors, here we start with the process. As you know, we have already engaged with the manager, the board. It should be all full aligned, but there is a long process with the shareholder because even the board and the founders has some rights. When it comes to secondaries, there are rights that the shareholder can tag or can have their drag, or can they also participate to the secondary. So there is always some time for preemption. It will take technically between 20 to 40 days to have a serious closing, depending on the shareholder agreement.
Yeah, okay. Very cool. We just have one question from Ian Soso. He asked, how do you deal with secondaries from SPVs? And he asked the follow-up questions. Do you sometimes buy the SPV itself?
Okay, the fact that there are some people in the market that buy SPV, the only reason that they buy SPVs rather going straight in the cap table is that either there is not a full alignment with the company, so they want to do that behind the scene, or with the alignment of the companies, they don't want to go for the formal process, right? In our case, at Giano Capital, we don't want to do that except for the case where the companies will give us full access and will let us know, okay, look, we don't want for ABC reason, that might be good reason, to the full process, please buy the SPV. But usually we don't do with the consent of the company because A, we will not have access to the data room, and B, we're not going to have a relationship. The other side of Giano Capital is once we are in the cap table, we want to be supportive to the founding team, to the manager, and we want to have a very, very friendly relationship with the boards and the other shareholders. So we want to be open and to stay behind the SPV. This is not for us the right way to do things.
Yeah, very cool. Okay, so Gianno, now, Gianno, Alberto, now I have a question for you, and is in a completely different direction because we've closed the topic. We've just run through the whole process of how you evaluate an asset. Now I want to go into a different part, which is the preparation for a sale from a fund. So if you're sitting here as a GP and you're thinking, how do I, should I be active in the secondaries market? How do I get started on this? And here I'm thinking about things like the portfolio assessment, the valuation preparation, all that work that goes into it before you execute on anything.
Okay, as a fund level, as a GP, mainly early stage GP, you have to consider how much DPI you have in your fund, which is today a critical number. So when you realize that you need to look for liquidity event and DPI, and when you realize that secondary is your main route, then you have to look at what are the assets that can get you DPI and can help you to raise your next funds, and how much is the stake you have, what could be the likelihood to have evaluation and liquidity that make you happy. So this is an internal homework that you have to do, because then when you're going to approach the companies, you need to be sure that this is the right fund, the right company you want to approach, right? And there is appetite in the market, because worst thing that you can do is to try to start this process and then you realize that the company is not appealing in the market, so there's no way that you get secondaries, and you are going to be frustrated. You are going to get resources internally and maybe also from your portfolio company. So it's a very, very important decision that requires attention. But I believe most of the early stage GPs knows exactly what are the company that might have chances to be, sold part of their stakes in the secondary market.
What would you just, to hammer home the point, what would you say are the things that you would look at? What are the signals that this market would, this asset would be attractive in the market?
Okay, first of all, revenues. So you must be sure that a company is doing at least 50 million revenues. You need to be sure that a company is growing at least 30%. You need to make sure either the company is already profitable or already fully funded, which means they're going to be profitable and they don't need further capital increase. Because there are three elements that a secondary buyer usually doesn't want to take as a risk, because we are not there to take such kind of risk. Then the further layer is to see that the company has a likelihood to have an exit, I would say in the next 3 to 6 years. I go longer than John, 3 to 6 years. And you need to see that the potential market for the exit, and you need to see alignment of interest with the other, shareholder. When these elements are there, then you have to see if your company now it's enough trendy in the segment, how the company is a market leader or not, who are in the cap table, how you can be supported, what is the sentiment around the companies, what are the plan for the next 2 to 4 years, why the company should be appealing for someone. There are a lot of reasons where you can say yes or no to a company. So you have to ask yourself before going into the market.
Yeah, makes a ton of sense, and I think that these were actually, incredibly important to get pinned down. I think that there might be some things that would surprise some people there. Why can I just ask you, like, is a fire sale, is that completely impossible, or would it be like, is there any way to go about saying we've lost belief in this company, we'll sell it at a steep discount, so to say, or is that just not worth anyone's time as a seller?
For Giano Capital, we don't want to do that because we're not restructuring. We don't want to take this risk. We want to go in the best-in-class companies. We want to stay in the safe side of the market. So we're not going to look at this kind of transaction.
Yeah, so fire sales are typically in VC not viable because of the state of the companies. It's only interesting if it's a potential restructuring, and that's where you want some real revenue in there, and you're not having everything tied up on future growth. Okay, now let us take us into the valuation preparation. How do you prepare an asset? So you found the asset, you're saying this is the one we want to go with. You've asked the market, tested a little bit, make sure that this is actually an asset that we should bring to market and go to the founders with. How do you prepare this asset for valuation?
You have to do the job we do internally. You have to look about public comparables. You need to look about other private company comparables. You need to do a lot of research and information. And then you need to be honest, apply honest multiple. And then at least you have a price per share. You have a case to defend in case the buyer wants to be too much, I would say, greedy or too high discount, as usually in this market they say. And then I think this is the best way, because you have to know what is the value of your asset, right? But not like a dream. It has to be like factual.
Are there any entities in the market that are good at helping be a sounding board on this?
I think any of the big banks can help you. I don't know if you're going to do for free and how much they're going to charge, or you're going to have some friends working in banks, and you're going to start downloading official public company from Bloomberg, and then you research in PitchBook, you go Crunchbase, and then you call colleagues, because also what is good things about our industries, and I really believe it's one of the very good points if we compare us with PE, right? In PE, typically, people compete each other, because usually when you find a company, you want to get it alone, either the majority or the minority, but it's you and the founders. That's it. In VC, especially in the early stage and also sometime in growth stage, we are happy to share the risk. So we are by definition sharing. So we can share information. Of course, we have to maybe sign confidential agreement. We need to trust each other, but we are a community, right? And I will not be surprised if after this podcast, someone called me to ask me, what do you think about something? I'll be happy to take 10 minutes on email, on LinkedIn, to answer to questions and support people. In exchange, I'm pretty sure that if I will ask to a GP, what do you think about this company? And they might have expertise that we don't have, and they will support us. So this is one good side of our industry. And I will invite everyone in Europe to, to connect more and more and help each other and not being jealous, and sharing. It's an important value.
Absolutely. I also want to ask you, just because you shared with me earlier, and I'm sorry for going back to pricing here, but I just want to ask you, because you've spoken to me about this idea of when you're doing your valuation comparable work, you're thinking about bull cases, base cases, and bear cases, and I think that that's a good framework for people to think about this. So, yeah.
Okay, so our base case, let's start with that. It's always management plan with a haircut between minimum 20 up to, I don't know, 30, 40, maybe 50%, depending if we need to apply another 20%. Usually it's 20, 30. But let's say that we receive information that the founder is always missing by 20, 25%. So we need to add 20 plus 25, so we are 35, 40%. But let's say average is 20 to 30% haircut, and this is our base case. So with our base case, with the public multiple, we need to make sure that if we enter at, let's say, €1 price per share, in 4 years, we are capable with this same multiple exit at 3 times, and make sure that we don't have any suspect or reason to believe that the multiple will be lower. This is our base case. Our bear case, it's maybe 50, 60 off from the management plan, and the bull case is the management plan.
Yeah. I just think it's an incredibly relevant framework to think about, just at least in terms of preparation in your own mind as someone who might be thinking about selling. Factors influencing pricing for sellers. I'd love to ask you, what are those? The market conditions, the asset quality, the asset details. What are the things that you're seeing very much affecting the price when you're looking at an asset?
Okay, first of all, the quality of the information that the company is capable to share. This is a very critical point, because if we're not happy about the quality and it's not enough deep, the way we look at it is say, that feels suspicious, or it's not suspicious, but we believe the company is not enough professional. And we say, okay, is this company deserve, and is this company would be ready to be sold, I don't know, 500, 700 billion into 3 years? Probably not. So we also look at the quality of the answer, at the quality of the documents that they provide, at the sophistication of the manager, at the approach. And then, of course, this going back also, who are your board member? Who are your... Assume that if in the customers, they will support you to being extremely professional. So that can be affecting the price, can be affecting the decision going to go further than other reasons.
And then you have market conditions. So market conditions, is everything there baked into the public market multiple? Meaning that once you have that, if, we used to have 20x SaaS multiples, now we have 5x SaaS multiples. And that is obviously a market trend that's baked in. Do you stop there, or do you say, no, there's also specifics to this company or to the geo that we're in?
We of course look a specific case. And again, as I mentioned before, sometimes we accept premium to the multiple. So let's say SaaS today, I don't know, 6 to 7, let's say, right? But your company is growing higher. Your company is higher margin. We might increase this multiple, right? And of course, we're not going to dream that in 3 years we're going back to 20 times, because we don't know, and probably not. Okay, but we are going to ask ourselves, and if we are pushed, we're going to be smart, because at some point, what people has to understand that as a buyer, we need to be conscious how we invest our LPs and our own capital, because as a GP, we also invest our own capital. On the other side, we need to invest the capital. So I don't want to do not do any deals because I am, too greedy. I offer too low prices. So there is always a balance. And there is another fact that for us is very important. It's the image we have. We don't want to be seen as someone that takes opportunities because you are desperate about liquidity. This is not approach. This is not our approach. And that's why I said we don't want to talk about discount. I don't care if you need liquidity in 3 months or you don't need it. I will price you pragmatically and factual, and I will explain. And then I'm happy to exchange and to go in your direction if you have good arguments to make my mind changing and increase the valuation. It's going to be, again, a factual and pragmatic analysis. It's not going to be an analysis depending on the fact that you need the liquidity. And I say, okay, I can make 10% because Andreas needs the liquidity. This is going to be one time, but it's going to affect our long journey. And because we want to stay in this market 25, 30 years, and we want to leave this for our next generation, we're not going to do that. We're going to be always fair, always transparent. We might not agree today on a price, but we are going to always have very, very good relationship and very professional.
I just wanted to ask you, we have a question from, and I'm going to take a few questions from the audience here because we're coming up at the end, and I just want to make sure that we're covering them before I close. To anyone really loving this conversation, wishing you heard much more, we are going to do a series of masterclasses with Alberto. We're going to do them both virtual and in person to try and make sure that we can educate as many as possible around this topic. It's obviously incredibly needed in the ecosystem, and it's something that we haven't really been able to find good resources on elsewhere. So that's why we've decided to, together with Alberto, really create a concerted effort to bring you some core content here. We have one question here from Arash. He asks, how much would be a satisfactory return over the life of the fund? And how long should the fund exist ideally? And I think he's thinking here about a secondaries fund. What are you telling your investors, in other words, when you're saying this is why a secondaries fund is an attractive proposition?
Okay, I will share what is Giano Capital Fund Life and Strategy. Our fund life is 5+1. To reach this goal, we have two rules. The investment period is short, is 18 to 24 months, and the holding period is up to 4 years. And with that, we can technically guarantee 5+1. In terms of return, we are aiming on average a 3-time gross return, which then leads a 25% net IRR. When you think about the kind of company we have discussed and the kind of risk of bankruptcy that this company historically has, and I can share this is less than 2%, what we're saying, you are assuming investing in Giano Capital or in secondary single asset, when you do properly, you're assuming a private equity risk with still a venture capital return. Why I'm saying that? Because the underlying asset, as mentioned before, we want it's growing 30 plus. And usually this is a venture capital return. And why we selected venture capital? Because the power of digital growing 30-40%. This is what we call the risking power. 2, fragmented cap table. That the fragmented cap table help us to jump into the company and being very flexible, which is not the case when you have a GP-led transaction, private equity. It's more complicated. We can invest 2 million in a company today, and in 3 months, another 2 million, and another 5 million, and increase our position. So, and because the company, since inception to exit, is 15 years, so those are the 3 main reasons we select this sector.
Yeah, very cool. I have one final question that I want to bring up, and that is from Vuyo. And Vuyo is asking you, what are your thoughts? And I know this is not the space that Gianno covers, but in general, what are your thoughts on earlier stage VC secondaries? So that's Series A, and before you have considerable growth, before you have break even, before you have, any price rounds, maybe there's only safes in there. What is that, viable at all, or should people just say, no, forget it?
I think that could be an exception. Why I'm saying there is, if we go back, and this is for me common sense, if you go back, who can be the seller? I would be surprised if there was not a strong personal reason that a BA at a Series A want to liquidate his participation. So my first question would be, maybe this guy want to exit because he knows something that I don't know. So I need to be really, really careful. Exception, if this business angel has, I don't know, family problem, he's going to divorce, I will consider when there is a strong reason. If it's not the case, I will not. If the founders do that after 3 years, it would be, again, a bad signal. I would say, hey, look, you're trying to build something and you start leaving the party a little bit too early, and this is not alignment. So I don't see that, except really, really rare case. For me, it will be a negative signal.
Yeah. And then final question before I close our conversation today. It's from Johannes Hauser. He's asking, what if a GP wants to sell a bundle of companies, better ones, and also the long tail companies? Could that be done? And again, you said this in the beginning, Alberto, this is not something that you do. you don't buy bundles, but it's something that Isomer Capital does, as an example. So this is something that someone would buy an LP stake, or you've got. You also saw publicly announced that that Molten acquired part of the remaining Seedcamp portfolio. So this is something that definitely happens. But maybe you could talk a bit to that before we close, Alberto.
Yeah. Actually, in the market, you have more funds and more buyers that are happy to buy a GP bundled companies for one reason, which I don't agree with that, diversification, because they think they jump in one transaction and they can get immediately 15, 20, 30 companies. They can price it better. They know that 3 are great, 2 are medium, 5 are crap. We don't do that. But there are a lot of buyers around in the market, so it's more easy. And of course, this is more a GP, led transaction. And we want to stay close to the company. We want to stay on single asset. We want to deal with founders. We want to deal with an exit. And we don't want to buy bundle, but there is a lot of players in the market.
Yeah. And now you say a lot, but I think it's important to say that in Europe, there are not a lot that buy small bundles even. So here, as you also said in the beginning, Alberto, for you, the sweet spot is close to 10 million, 5 to 10 million, I think you said. And it's the same thing. There's not a lot of actors that are working in the 1 million, 2 million sizes. But it's where Isomer plays. It's also where Molten plays. So there are some, but it's typically the smaller players, so to say, because most secondaries actors are billion-dollar funds. And that's also why I love working with you, Alberto, because you're looking at these assets that a lot of people in Europe have, but that they don't necessarily have an easy way to find buyers for. Alberto, any final remarks before we close?
No, I think it was very interesting. I really appreciate the question from our audience. And again, I thank you very much for the invitation, and congratulations for what you're doing at EUVC. It's a great podcast.
Yeah, thanks, Alberto. I'm humbled every time someone far beyond my abilities says that. So thanks a million. Thank you, everyone, for tuning in today. I really hope that today's conversation with Alberto was fruitful. If it was, do make sure to go on EU.VC for much more content like this, but also for our series of masterclasses that we're going to do with Alberto. These are going to be small group settings, both in person and virtual, so that we can do something really special where we can go for 3 hours, really dive into these frameworks that we've talked about here, because obviously that's a very different thing than just discussing the highlights here. Thank you, everyone. Hope to see you. Yes, go ahead, Alberto.
Last, if anyone wants to question, you can reach me on LinkedIn or send me an email. I'll be always happy to take questions.
Alberto, you are a true champion. I struggle to keep up with my LinkedIn, so sorry to anyone that has reached out and I've been a dick. I'm on email on a@eu.vc, so feel free to reach out there. I'm a bit better to keep that down. Thanks, everyone.
Thank you.
Here's a few words from our beloved sponsor. This episode comes to you by the support of our partners, Portfolio IQ by Synaptic. Portfolio IQ is the most effective way to track your portfolio. It pulls data from all sources, board decks, financials, MIS sheets, forms, emails, everything, and creates a true single source of truth for your portfolio data. With Portfolio IQ, you can track all the metrics that matter, not just the standard metrics. All metrics are reviewed by a team of certified accountants. You'll get 100% accuracy. Not sure about a number? Just click on it to see the exact cell in the document it came from. Portfolio IQ also adds a layer of standardization to make the data comparable and useful for benchmarking, valuations, and reporting. All of this is as simple as forwarding an email. Zero added work for your fund or your portfolio companies. Portfolio monitoring that you'll fall in love with. Go to synaptic.com/portfolio IQ. That's synaptic.com/portfolio IQ. The good folks at Synaptic will be happy to give you a no-cost trial.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.